Hello, Warriors. Everyone doing okay? Welcome to Face. Hello, Ann. Nice to meet you. Okay, so I'm starting off here showing US dollar yen. As we're getting a bounce in the dollar, yen held important support, but what I see developing here is a descending triangle. We'll see how the yen fills this out on this dollar rally. Could it be this deep? Here are the levels I see back towards 850 is the first level, and we only retrace 50%. So depending upon the how it responds, could even see 61.8 back. Now you look at this chart and you see how we got all the way back to these lows, and then look at the Dixie, which we put in higher lows. See, the yen got all the way down here, dollar turned before it got here. So, I'm not looking for new highs in the dollar. What I'm looking for is something like this from here. Talked about it yesterday on Turnaround Tuesday. This forecast was right. So I'm thinking we can trade above 101 if we have equality here, maybe 101 and a half before the next dollar failure. So that's going to tell us when the right time to short the yen is. With this going on, you are getting, I believe, an important turn in euro pound. So it was diverging all the way down here. What's interesting is I normally look for euro pound to be good when the dollar is bad, but it seems to be the opposite way. And when I look at euro pound on a weekly, first of all, the monthly had a big confirmed high, so even if there's a bear market rally, we could see 89 or so. But when I look at it on a weekly, or maybe it was a monthly, just a real macro view of EG. So if EG is heading up, now pound, which has been outperforming, is your preferred short on rallies, and euro's your preferred long. Okay, so it must be, yeah, kind of maybe one, two, three. I did see a look that you know, was pretty clean. That's pretty clean. Here's one, here's two. So on the weekly, it didn't confirm, and maybe you get a three over 94. So, um, you just have to trade the chart. Normally, I would say this would be bearish for the dollar, but it seems to be working when the dollar is going up. So maybe it's just going to be a rally back towards this level. See, 89 be a pretty small retracement of this correction. Uh, Want to talk about the gold briefly? We may have peaked at least short term here. Talked about the weekly divergence. We're still sharply higher on the week, but glaring here. And with yesterday's rally, need kind of a down day. Gold still has not confirmed, but you see this divergence. And the 4 hour, the readings were pretty high, which is why I don't trust it. But on the 1 hour, had some pretty good divergence up here at the highs near 1748. We'll see. Of course, true to form, silver is a lot weaker today. This action here in the holiday or whatever kind of screws up the short-term charts, but we almost got back to 61.8. Here we are holding 50% retrace. Silver's come a long way, and I pointed out how you could line up silver chart to S&Ps. Look how similar it is. S&Ps, silver. And on the S&Ps, I had heard 2850. I think it was Jim Walsh who came up with that number a while ago, 2850. And when you look at it, you could see a three. I talked about a three forming. Here's one, two, three. So, there is divergence here. I'm not short. I want to see if this three follows through. And here's something I was wrong about. I tried to buy crude yesterday. I was stopped. We have new lows here, but on the daily, just be cautious about this. And look at this. So, it looks like it could wash further, but look at this glaring divergence on the daily. So, people say, well, you're wrong. You lost money trying to bottom pick it. Steve said an interesting thing yesterday during his analysis that you may have to take a couple of shots to get a turn. And that's why if you take partial profits, you actually could, be wrong for a while on the turn and still, either subsidize a loss or actually be making money. So this may be another shot, but it's not a time to short it here. This RSI reading well above 30. It took out this low, I think, by about 10 points. Oh, and I wanted to show this because Steve has also talked when the dollar topped that some of these exotics are really going to be big trades. Look at USD MEX here. Everyone see this pattern? What's missing? Come on, this is your pop quiz today. What's missing on this chart? I know there's at least 50 in here that know what's missing. Joe's got it. One more high. Third drive, Ben Maldonado, Anders, Paul. Look at you guys. So I just want, for people that don't know what a third drive is, a third drive is not two mulligans and then the next tee shot counts. Okay? That's how I play golf. Could I take a mulligan? How about another mulligan? Okay, the third drive, it counts. Anyway, so I wanted to show USD MEX. I might be under some pressure on my interest rate forecast. I think we're going to know pretty soon. The bonds with the S&Ps off 50 are coming off, so we'll see what happens here if we're going to head back down. Here's your 10-year. I was thinking this was a low and we're going to head up here. So with the S&Ps beginning to sell off here after a tremendous rally, this is the time if rates are going to head back down to do it while there's risk off. So we'll see what happens here. If we can't wash out on the 10-year and the 30-year and TLT, which was, hanging right here at 61.8, if it can't blow through 78.6 with risk off and a lot of pressure on stronger dollar, etc., then there's something wrong with the bonds. And the last thing I want to show is look at this is an ETF on 20-year treasuries. Look at this. Okay, so this is the Fed. So actually the commercial bond market is outperforming sovereigns. And then I also have junk. So people ask, why do you pay attention to the bond market? Well, because it's almost as important as the currency market and more important than the stock market. So here's junk. Yeah, junk just failed, up here. Looks, this looks like a failing rally in junk. But actually, the Fed has been more effective in the commercial paper market than in our own treasury market, and definitely not in junk. So, phew, wow, Blake, I almost talked 10 minutes. It's a face record.
Hey, good job.
I can't believe I used to do it for an hour.
I know, it's crazy, huh?
Remember how you did it for how many hours a day during that
4
Wise Trade?
hours.
Wow, that
4
takes a
hours.
lot of stamina.
My morning
Mental.
edge was 2 hours. And
4 hours is the warm up for Steve.
Yeah, right.
not today.
Yeah, today is not a good day for that.
Yeah, Steve wants to take the day off. Anyway, so good morning, Blake.
Good morning, guys. Good morning, Dale.
Good morning, Blake.
Here's Steve and Stelio. So We have had some action overnight. A lot more movement than I wanted. I mean, it was good. I was happy with what happened. Let me see here. Okay, so I picked up some Euro Aussie yesterday. I picked up some Euro Aussie down here at 170, 170.62 yesterday, and I woke up this morning and we were trading at 172.50. Took that off the table. Well, obviously a little early. I'm looking for a pullback here, but with equities staying weak, the risk is that we're going to continue higher in the Euro Aussie. But you're seeing risk aversion come out just because we rallied to these have been my charts for the last I don't I've had this
weeks.
For weeks, right? This is the resistance zone. I really didn't think we were going to stretch all the way up here. I mean, I thought we were going to get to the 50% retrace, but I didn't think we'd get all the way to the spike low from back in February. But we did.
It's weird about 28.50, and Jim had talked about it. There's no fib level there.
No.
So,
no.
Well, what is there, Blake, that you were able to come up with that orange zone at 28.50?
Right here. I'll delete this and I'll just take this one and
okay.
I'll do it here in a second. Spike low, right?
Oh, okay.
Yeah. Spike high. So I knew that this zone right here, spike low, there's a spike high. This is all resistance.
All right. So traders, learn this. The market memory, look left.
Yeah, always look left. That's a great recommendation, Dale. Is always look left. And in this case, we just came up to I try to draw like support and resistance zones because markets aren't perfect. If they were perfect, we'd all be gazillionaires. I mean, if it was just everything matches up to a T, and obviously we try to find confluence, but it just isn't always going to happen perfectly. So, and in this case, like you said, there was no fibs. I knew that between the 50% and the 618, we probably were going to find some sort of resistance up here. The stock market is still bullish. Keep that in mind. We may be pulling back a little bit today, but we're still bullish here. As far as the equity markets go, while we're above, the Euro Aussie is ripping again. Oh, man. Well, this is great because I'm short Aussie dollars, and Aussie's coming right down to support. You can see we're getting real close to like a very pivotal area in the Aussie dollar. So just watch the Aussie down here. I think this is going to be really important as we get below 63 cents. We're getting close, but lots of little bit of risk aversion as we've come in. And if currencies continue to do what they're doing, you have to expect that we're still going to see more selling in equities. So that's the one thing that you've got to keep in mind as the dollar stays strong, especially against commodity currencies. I would expect that the stock market continues to stay relatively weak. All right. And also keep an eye on, like I said, the Euro Aussie here is a great indication of how the stock market is, should be performing. I think the Euro Aussie is going to come up to some pretty key resistance once we get to the 174, 175 level. And we're, 150 pips away from there. So we've got a little bit of distance to travel before we get to that area. I am trying to buy dips this morning. So if I can get a dip in the Euro Aussie down to 172, I'm a buyer. But that may not happen. I mean, it may not happen. I think one of the big, one of the currencies we need to really pay very close attention to today is going to be the US dollar Canadian. We do have the Bank of Canada rate decision today, but more importantly is, and I took my dollar Canadian, I had a really small dollar Canadian on yesterday evening when we were below 139. And I didn't expect it to get all the way up here. That's why I just kept it really small. I didn't think we were going to be breaking out already, but now we're above this, this pennant. It is bullish. Now we got to look for dips back down to 140 to possibly be long. Yeah, like I said, you have the Bank of Canada today. I would assume at this stage in the game, the dollar Canadian pulls back at least a little bit ahead of the Bank of Canada, because it is the BOC rate decision, and you're going to get some people paring back some positions, I think. But we'll see. We'll see what happens. But the Bank of Canada is happening at 10 a.m. Eastern. They're expected to keep rates unchanged, but as you can imagine, they're going to be pretty dovish. And really, with the sell-off that we've seen in crude oil, I can't imagine the Bank of Canada being very optimistic at all. You saw the jobs report in Canada. You saw you've seen crude and how it's performed. You know that Canadian GDP is comprised a lot of crude oil exports, and with prices where they're at, this is not a good mix, for the Canadian economy. So there's a good chance that the Bank of Canada is going to be pretty dovish, and if they start talking, negative rates, then you're going to see the dollar Canadian really get smashed. But right now, we got to watch the dollar Canadian while it's above 140. I am a buyer. I want to buy dips if I can find them. I don't want to chase, but the fact of the matter is the U.S. dollar Canadian looks like we're going back to the mid 140s right now, and that's something that I think we all have to be very cognizant of, is that it is on its way. And again, it's just trying to find a strategic level to be a buyer. And I'm trying to figure out where that is at this point. I'm going to go back and take a real quick look at equities. So here,
Blake, there is a good question for you. You might want to address. Jason is asking, when you were in Wise Trade, he says, I noticed that you did a lot more swing trades.
I saw Jason's question yesterday, and I'm choosing not to respond.
Okay.
No, I'm just kidding. I didn't. I saw it yesterday late before I came off the daily roundup, and I tried to answer him on the daily roundup, and he priority left. But his question was, hey, I noticed when you were with Wise Trade, you're more of a swing trader. But now that I'm trading for a fund, I tend to be more active. It's just a simple fact that I'm trading a lot larger positions, and really, if you look at not so much the way the market is acting now, but the way the market was acting really for like the last year and a half, the opportunities for swings were a lot less. So now you got a little bit better opportunities for swing trades. Like, for example, I traded the Euro Aussie for, the last 12 hours on the long side. But it's usually a case of just trading larger sizes. I'm trading probably 20 to 40 times the size that I used to be trading. So that's a big difference, when you, and it's psychological too. I mean, if I take a position and all of a sudden I'm down 10 grand, it's, I tend to be a little bit more trigger happy on getting out of that position. Or if I'm up 10 grand, I'm a little bit more trigger happy on taking that position off the table. So the sizes that I trade, drive me to that. And it's not, and the one thing you have to also keep in mind, Jason, is I didn't come from an institutional back from an institutional background. Although when, I was 26, 27 years old, I was trading pretty large size for equities, and I'd make a couple grand, make it 2, 3, 4, 5, 10 grand in a day. No problem. Now it's like I can have trades that look like that. So I tend to be, like I said, a little bit more active. Just kind of, oop, I'm down 5 grand. I need out. Or oop, I'm up 10 grand. I need to take that. Or also, if I'd come from like an institutional background where I'm like, like Stelios, where he trades, he's like, oh, I'd move a yard of currency, and, seeing your P&L, or the bank's P&L fluctuate by, you know, tens,
50K was noise.
dollars. It's like, oh, big deal. You know what I mean? It's definitely a mindset. It's definitely a mindset. And
Elio, what is the largest number you've seen in a P&L swing over a day in the bank?
for me,
No, Stelios.
oh, Stelios. Yeah.
I didn't have huge swings like other people. My best day ever was something like 4.5 million, I think, 4 and a bit. And worst day was something
That's
like
not bad.
3. I had a -3 day as well, which was bad. But anyway,
yeah,
I
but
wasn't one of the big hitters. There was
when you see those numbers, Stelios, you become a little bit more numb to them. And I mean, and then when you trade, when you're trading your own money, or you're trading, for a smaller fund or something like that, and you see, oh, I just, lost 10 grand. You're like, you just shrug your shoulders. You know what I mean?
Yeah.
And I came from the opposite standpoint. And also, if you think about what I was doing 5 years ago, 5 years ago, I was pretty much trading 100 to 500,000 in currency at all times. And I could swing it, I could swing 100,000, or like, let's say 200,000 in the euro dollar, and I'd get a, 200 pip move, and I could make 4 grand over the course of a few days. It's like, oh, okay, I'm going to book that. And that's my own money. So, for me, it's like, oh, I just, did that. And we had the opportunities. There was the trading ranges were a lot wider. Just a few months ago, or 2 months ago, 2 months ago, we were having 30 pip trading ranges in the euro. So I'd have to trade, 4 or 5 million euro dollar, try to make 20 pips, and pull a few grand out of the market. I mean, scalping it, and that's just, it's kind of, you end up being a product of your environment too. So not only is it mindset, the dollar amounts you're trading, but it's also, what the market's giving you. Right now, the market's giving us a lot of volatility, right? So
Yep.
Nick Leeson wasn't afraid of the numbers. That's how he took Barings down.
Yeah, well, yeah. If you guys have never seen Rogue Trader the movie, you should go see Rogue Trader the movie. It's
true story.
Rent it. I have it at my house.
He's the king of averaging out, wasn't he?
What's that?
Wasn't he the king of averaging out and adding and adding and adding to the position?
The official name is martingaling.
Yeah, that is a martingale strategy, and a lot of people have tried to employ that over the years, and that's just one way to really get yourself out of this business rather quickly.
Yeah.
The huge danger with martingale is that you do it 100 times, 99 out of 100 times you feel like a king, and then the 100th time you lose everything.
And you're a pauper.
And that's how it ends.
Yeah. So, hey guys, just to, I made this point on yesterday's webinar, and I'm going to make it again here. The dollar is very, very difficult. If you're trading the dollar outright, it's very difficult to gauge. Yesterday, if you looked at the euro, we were trading up near 110, and it looked like, oh, we're going to the 618 retracement, and then now, the euro's on its back, and we are breaking through all sorts of support. And same thing with the cable. The cable is just trading at 126. We're trading at 124.50. The dollar is very hard to gauge right now.
It's all overnight too, Blake.
Yeah. The one thing we have to think about is dollar strength. It is still strong, and it's used as a safe haven currency, and it's shown today. that as the market is risk off, the dollar is stronger, no matter what the Fed is doing. I think the dollar's upside will be limited, especially whenever this, we're done with all this, risk aversion. We get past like the coronavirus, but because of the coronavirus is still very apparent, we have to keep that in mind, that always in the back of our mind, that the dollar is at risk of a strong rally if stocks start to roll over. Anyway, I'm going to pass it over to you guys, but I want to say, if you guys haven't tried out Forex Analytics, make sure you do so. It's only $1 for 10 days to try it out, and when you try it out, you will be in the premium plan. No matter if you're doing the premium or light version, you'll be in the premium plan while you're trying it out. So $1 for 10 days, give it a whirl. Download the mobile app while you do that. And guys, I want to pass it up to you.
Good luck today, Blake.
All right, thanks, guys.
Thank you, Blake.
Blake,
yes.
Joe proposed that we announce today, the event. So I don't know if you want to.
I already kind of announced it yesterday, so you can talk about it. Go ahead.
Okay, bro.
All right.
Okay, bro.
All right.
Okay.
See you later.
Thanks, Blake.
Bye-bye, mate.
Well, we have three minutes to the numbers, so if you let's talk about the event a little bit, and then we'll go through this stuff.
Yeah, so we are happy to announce that we're going to be having a 2-day event. Each of the days starting with FACE, but the rest of the event being really high esteemed speakers, and I'm going to give you a look now. The site actually is going to be up within the day. It's currently being transferred to a live site, putting some last things in place. We're going to give you more details tomorrow, but you can get an idea. This is Trader Summit, right? This is how it's called. As you see, going live in a little bit less than 14 days. And here are some of their speakers: Peter Schiff, Mark Chandler, Mark Yusko, Peter Bukvar, Peter Goodburn, Mark Newton, Adam Button, Boris Losberg, Jamie Saitley, Steve Vanton, Blake Morrow. I don't know if you know that guy, Blake Morrow.
Nice lineup.
It's a pretty decent lineup, right, Coach?
Take that, CNBC.
I'm very excited about it. Really
excited. It's a pretty decent lineup, I have to say. So we're going to give you details. One more thing, since FACE is going to be, if you see the program here, FACE is going to be kickstarting the event in both days, right? In order for you to watch FACE during these days, you'll have to register for the event. It can't happen otherwise. It's not that we're doing it on purpose, but if FACE was to be part of the event, it would have to be on the event's Zoom webinar. So it can't be both at the same time. So unfortunately, FACE is going to be happening without an interview. So it's the 1 hour of FACE to begin with the event. But since it's going to be part of the event, those 2 days, 29th, it's a Wednesday, and 30th, which is a Thursday, it's going to be part of the event. And you can see here the lineups. I mean, pretty awesome, right?
I'm so excited, man. Seriously.
Yeah, same here. Same
it's
here.
Great.
So yeah, so I seriously think that it's going to be absolutely worth it. Personally, I'm looking forward to plenty of those people speaking, but I'm not going to lie.
Go ahead. You have this poster up in your bedroom.
No, I don't. But we, but very much that I'm also an Austrian, economist. So looking forward to Peter Schiff. I have to say that.
Yep.
And
Same
Coach,
here.
you're going to have to tolerate my presence there.
Okay. It'll be fun.
It will.
Awesome.
It will. It will. And by the way, one more thing I wanted to tell you, and very seriously, people are going to have presentations there, but most of them at the end of their presentations, they're going to have like 5-10 minutes for questions. So you will be able to ask questions.
Nice.
But most importantly, Peter Schiff and Peter Bukvar, they're going to be interviewed live. Let's go through the data first, and I'm going to tell you. So let's see what we have.
Yep, retail sales in Empire State Manufacturing. Empire State, very, very negative. Retail sales, roughly where
US
expected.
New York Fed manufacturing minus 78.2 versus minus 35 expected and minus 21.5 previously. Retail sales minus 8.7%, with expected being minus 8. US core retail sales minus 4.5 versus minus 4.8 expected. US retail, the rest are kind of details. Yep. Okay.
Yeah, this is not definitely not good for. I mean, theoretically, stocks should be going lower anyway. And actually, no, you can. Let's finish off with the what you were going to say about Peter Schiff.
So Peter Schiff and Peter Boockvaart are going to be live interviewed by Dale. I'm not going to stay out of the Peter Schiff interview, I have to admit. So I'm going to put a little bit of a finger there. But what I wanted to say is that if you have some questions that you want to send over, do so. And if there's some really good questions that haven't been addressed, we're going to be more than happy asking them. Okay.
So when can people start registering for it?
They will be able to start registering at some point today. So
what are we going to do? Tweet it out for people to see, or?
Yeah. So to be on the safe side, I can tell you in advance that we're going to be able to give you the link at tomorrow's webinar, no matter what. I mean, the site is going to be up a lot sooner than that, but tomorrow for sure you will be able to register online for that. Okay.
Perfect. And Dale, I want to remind you that you're going to be able to mute Steve, so just keep muting him.
Nah, sorry, he can't.
Okay, so let's talk about what's been happening. I mean, the main event has been two things. First of all, oil dropping more today, and we talked about this yesterday. The cuts that were proposed and are going to be implemented for the next 2 months from OPEC Plus.
Here's crude, by the way.
Yes, where broadly, actually, we're really on the low side of what the market was really hoping for. So it's probable that they're going to probably announce something further as the days go by, but really it doesn't seem to be doing anything to stabilize oil price. I would love oil to get to the low teens. I really love it, but I don't think it's getting there.
From a technical perspective, it's also going to be lovely, Stelio. Dale, yes. I'm sure would immediately call this a 3 drive, because we had a low there with RSI being there. We had then lower lows here.
Yes.
And there is a chance, seeing RSI, that if oil keeps dripping lower, this slowly, we can actually make it to like 17 or so, 16, 17, without posting a lower low in the RSI. So that's going to be also another, bounce indicator there.
Yes. And the other thing, obviously, is equities. We've been talking about equities on this webinar and on the chat room pretty much every day for a while. And I'm trying to find the chart that I shared in the chat room. I'll find it eventually, but we've been talking about this rally of the last 10 days or so. It had all the hallmarks of a bear market rally. We were talking about a target around 28.50. I was saying maybe it could overrun a little bit, how these things usually go. But the nature of this rally just made me think that this was a bear market rally, and that the next leg lower, the next leg will be lower. I think we're starting to see the beginning of this. How much lower is the question. Initially, I was thinking, 1,800 to 2,000, the S&P. I know it sounds aggressive. We might not get there, because let's not forget the Fed and pretty much every other central bank have pumped in trillions of liquidity. And
in essence, they've managed to decouple the stock market's price action with what's happening in the economy. And one example is what we see in crude. I mean, crude, in essence, is pricing in a big economic hit with a huge demand reduction, enough so to ignore 10 million barrels of supply cuts, while the S&P and the rest of the indices have kept rallying. And this is completely a fake rally. And I'm very confident, and it's easy for me to say so, because I'm not even angry with that. I mean, people that are here know that I've been long the S&P from 24.20. So I'm very, very deep in the money. But I only did that because I believed that they will manage to produce such a fake rally, because this is a fake rally. I mean, this has nothing to do with the real economy. Nothing.
Yeah,
And
the only issue is if you know that the Fed or proxies of the Fed are going to be buying everything, there's a lot of people who are going to say, no, there's a big buyer behind. Why not go long and wait? Well, I think that's going to play out. But eventually, first of all, there's going to be a leg lower. And where do I think the S&P is going to go? I think we're going to test those lows again, for sure. Whether they hold or not, it's a question that remains to be seen. I need to see more price action, but I think those lows at what was it, 2,300 or something like that, I think we're going to get there. And I've actually put my money where my mouth is, and my personal portfolio is now nearly 0% in equities, and I'm waiting for this move lower to materialize, at which point I'm going to start loading up.
At which point inflation should take it a lot higher. And keep in mind that even if you're not a proponent, even if you don't believe that these central banks actions are going to create inflation in the everyday economy, there is no doubting, we know that from 2008, that they at least managed to create a lot of asset price inflation. I mean, there is nobody that can doubt that. I mean, you can have an argument of if you think that this time it's going to spill over to the real, to everyday products, to products that consumers consume on an everyday basis, which I can tell you in advance, it will. It will, and it already does, and it also did in 2008. I mean, I've talked about that multiple times. Technology and evolvement are by default deflationary. I've said that before. During the century that the US, in essence, built the basis to become the economic superpower, 19th century that is, more than half of the time, the US was in deflation. Because whenever you have technological advancements, whenever you make processes of building things more efficient, and you reduce the cost of producing goods, that's by default deflationary. Under normal circumstances, with all the improvements and mass manufacturing and all that we've had during the last century, we should be in constant deflation, which I have to reiterate again, it's not something bad. They're trying to brainwash people to think that deflation is something bad, but it's actually extremely good. I mean, your money would be worth more. And the only argument that they're trying to serve about that is that if you have a deflationary environment, people are going to be sitting on their money and not doing anything with that, which is absolutely BS. And you can see that it's absolutely BS. First of all, have you ever stopped yourself from consuming a product, from buying a product just because next year it might be worth 2% less in real money? I mean, if you need a computer today to do your work, will you actually wait for a year because next year it might be worth a little bit less? No. Will it stop you from investing in a business when nobody's investing in a business to make 2% in a year, right? I mean, if you actually want to make 2% in a year, you're never going to be investing in anything. You're investing to make a lot more.
Steve, I think the danger with spiraling deflation was when money supply was relatively constant. That was the big difference, and this was like decades ago, right? Now with money supply and credit supply increasing exponentially, this will never be a problem. I mean, I don't know how else to say it, but really, a little bit of deflation would be perfect. And the risk of big deflation, I think, is near a 0% chance event. So I agree.
Absolutely. What else did we have, Stel, overnight?
We had some CPI readings from Europe. European countries, like month on month, has turned slightly marginally negative. Nothing really to write home about. So we're waiting for tomorrow's unemployment claims in the US, as always, and obviously the Bank of Canada in an hour and a bit.
Okay, yeah, Bank of Canada is going to be important. I'm going to come back to the come back to the S&P and the rest of the indices, because I have to say today is a very interesting day because we see potential reversals. So I'm quite happy to talk about the markets today. Yesterday it was a boring day. We have nothing really to talk about, but I think that today we're seeing some interesting market reversals, which probably will play out for the days to come. I want to start with USD CAD. Blake showed it, so I'm going to be brief about it. I do think that USD CAD has likely begun its next leg higher. You remember that's what we drew some time ago. I said that at or above 138 we should reverse low higher. We're now breaking above this channel. Quite a formidable daily candlestick here. I think there is a very, very high probability if we confirm by closing strong today that USD CAD has begun another leg higher towards at least 147 to retest obviously the previous high. You can see, for example, that USD NOK is doing something equivalent, which I did expect because momentum was already slowing. We're breaking out from there. I expect higher prices there. USD MXN, you can see again, period of consolidation. We might be headed for one more high. What do all of those have in common? That under normal circumstances, they should also pinpoint a reversal here in risk assets in the S&P, for example. And now I come to one of the latest questions that came through from Frederick. Are you going to take profits on S&P now, Steve? Answer: no, not yet, because I want to see some confirmation. And how will I see some confirmation? I mean, it's a very good chance that we got rejected from this horizontal support resistance area at 2850. I'm not saying no, but I could have fallen in the same trap in the reversal we had here 7th of April, and I didn't. So I managed to to stay for longer in this long position. So to begin with, I want to see how we close today, okay, and I'll take it from there. Because remember, I've said so, and I intend to follow through on that. When I close and take profits on my long position, I'm not just going to take profits, I'm going to reverse my position to short. Okay, so my intention since the very beginning was being long this market so I can, make some decent money to fund my short positions stop loss. So that's what I intend to do here. So one day at a time, I want to see how we close the day today, and we take it from there. So far, I'm seeing a rather negative start of the day, but so far nothing to really write home about, right? I want to see more evidence.
Look, it took a lot of patience for you to stay long as you have, and so congratulations. A lot of people would have gotten out at 38% or 50%, and here we are. So went above 50%. So a lot of patience. Like I've said, Steve, that's my shortcoming. Is I even told some of my mentees when I give them targets and objectives, I go, I don't know why I even talk about them. I never sit for them. But anyway, I have targets that are achieved.
I'm not going to pretend it's easy. What I'm doing is that I've uninstalled any kind of trading application from my computer. And I've said that before. And I only trade using my mobile phone. So I don't constantly have the P&L in front of my eyes. You know what I mean?
Yeah, see, we need to do all these little psychological tricks.
Yeah, so I try to avoid on days that I know that positions are working against me.
Yeah,
I don't even open my application to check my P&L for psychological reasons, because I know I have a plan to follow. You know what I mean?
Yeah.
So there's no reason for me to start looking at my P&L, because then you start having thoughts, and having thoughts is very, very stupid, because in trading you should be thinking before executing, not afterwards. Afterwards, in the vast majority of the cases, you should just following the plan that you thought of before going in the trade, when you could objectively make a plan because there was no stake in the game. You still had no position and no P&L.
So there's Steve's technique. What you can also do, I know a lot of you guys get into trades on the 1 hour time frame, or sometimes even smaller. Manage a trade from a 4 hour time frame. Or if you really want to stay macro about the position, manage it from a daily. and that could help you stay in the trade. And one other trick that and it's exactly what Steve is talking about. Someone, I've learned from a lot of people, and I forgot who told me this, but as far as staying with the position, ask yourself if you would reverse there. And if the answer is no, you walk away, just like Steve is doing today. Okay, so anyway, just a little mentoring here.
Joe is trolling me here. Did Steve just say having thoughts is stupid? Yeah, I actually did that. Trying to have thoughts at the wrong time is kind of stupid, because when you're trying to change your plan by overthinking it while emotions are running high, then you're usually ending up taking the wrong decisions. So I think in the vast majority of the cases, the decisions should be made with a being clear-headed, with a clear mind, when you're formulating a plan without having P&L push your buttons, push your psychological buttons, in essence. So the DAX, as you see, is also showing a nice intention to reverse from this horizontal resistance, still holding this ascending channel. But I have to say, it looks likely that we might have actually run our course here. Same with the FTSE. FTSE anyhow was producing one of the weakest recoveries here, so no big surprise there. I mean, it's remained one of the weakest. One more thing that we have to monitor here, Dale. Look at this. This is the VIX, right? Nice depreciation within this descending channel. Let's see how we close the day, but it looks like it wants to break out again. So
61.8 back.
Yeah, I mean, so everything is showing that perhaps today is going to prove to be quite an important pivot in the markets, including, of course, I'm going to show you, including the dollar. If you remember, I kept saying again and again and again that once risk sours, dollar is going to see more upside. Here is the DXY. There it is. Here's the DXY. Quite a massive update so far today, right on this horizontal support area. So I wouldn't be surprised if this is the beginning of something bigger here. So keep that in mind. It's working on a bullish engulfing on the daily. And at the same time, which we also warned about it, if you remember, I kept saying that these are going to be nice buying opportunities. Look at the Euro Aussie. I know that Blake showed it, but I wanted to show something extra. Look at where the Euro Aussie found support. We had this long-term ascending channel. Look at the Euro Aussie. Look at the Euro Kiwi. Look where it found support. So I think that Euros and Euro Kiwi, as expected, when we would get risk off again, are breaking out, perhaps showing that today's reversals in the stock markets are the real deal. So as I said, I'm not going to be jumping the gun. I think there is a decent chance that we're actually reversing here. It's still early on the day. I want to see how we close the day, but I'm probably going to be, reversing my position to short. And I do think that Euros and Euro Kiwi are looking quite nice for another big move to the upside. So bottom line, dollar seems to be reversing higher, with whatever that means for all the popular and non-popular dollar pairs. You can see the Euro USD has already formed on the daily chart an outside black candle, and it's still early in the day. The cable reversing from the 200 daily moving average, so a very nice rejection from the 200 DMA. Yesterday we touched it at the high. I said that we might actually make it to 127.10, where the 61.8 is, but as it seems we won't be. So I would really watch out here. I mean, if you were short the dollar, if you were long risk, you should start paying close attention, because today might be, as I said, a pivot day. So that also goes. We have questions about the Aussie. Look at the Aussie. I said yesterday that you should expect that Aussie and Kiwi rallies should fail rather soon when actually we get risk reversing, beautiful rejection from the 61.8.
Nice call.
We're about to test the confluence of this ascending channel trendline support and previous horizontal support resistance area. Here's the kiwi reversing from the 50% fib. Huge down day already today. So, watch out, because all that seems to be reversing. Here's the Aussie yen. A friend was asking here about the Aussie yen. I said, be careful, because we almost fill the gap, and the gap is the first area of resistance. So we were exactly there yesterday. And if we pass through that, I said, watch 70 for the 61.8. Doesn't seem we're going to be making it there. Here is Kiwi yen. Kiwi yen was anyhow the weakest, incrementally new high, and that's it, failed from there. So as it seems, we have all the ingredients of a very nice reversal day. A few hours left to confirm with seeing follow through. And I think that should be good enough for several days of weakness. And let's see how low we can go this time. We know that the Fed is going to be supporting and throwing everything it has at the markets. I said it yesterday, and I wasn't exaggerating, and I wasn't joking about it. The Fed has created 10 different SPVs, special purpose vehicles, that is, for those that don't know what SPVs is, during the past month, just to prop up and, in essence, nationalize different markets and give a lot of liquidity to organizations that will actually be also buying stocks. So it's not that easy to fight that. Having said that, the damage to the real economy is huge. And even if the stock market wants to do some catching up with that, also, I remember, if you remember, I said it early on, you might not realize that, but at the levels that we were yesterday at 28.50, going back to the chart, 28.50 in the S&P, we had summer of 2019. So ask yourself, back in summer 2019, what was the market pricing in? Was it pricing in a factor like the coronavirus that would completely shut down the global economy? Was it pricing in a very deep recession, as every institution is now acknowledging? From the IMF, the World Bank, every government has now officially accepted that there's going to be a sharp recession. They want to hope, and they're trying to predict that there is going to be a fast recovery from that recession. But there is absolutely nobody that refuses the obvious fact that there's going to be a deep recession, even if that proves to be short-lived, which I have very strong doubts about it. So, question. Back then, we were pricing in earnings that would keep increasing and an economic environment that was looking, let's say, good. It wasn't actually, but you know how it is. So when do you think valuations were higher? Back here or yesterday? Because keep in mind that the most basic metric for valuations is the PE, right? Price to earnings. So with earnings expectations plummeting, really plummeting, I can assure you that yesterday's high was at much higher real valuation than the all-time high at 3,400. So basically, you can go back and say, from one perspective, okay, the market is not that frothy. I mean, we were at 3,400 a couple of months ago. But in all actuality, if you take the vast majority of metrics, the market yesterday might have been the most overvalued market we ever had in the financial markets history. So if you look at it from that perspective, you have to reconsider. USD yen is decoupling from risk off on. I have to disagree with one thing. It's not doing it now. If you remember, I kept saying since some time ago that I've completely stopped trading. And if I am to be honest with you, I've almost stopped completely looking at it as well. I mean, I used to have USD yen on my charts constantly. Like one of the charts, I was looking at, all the time. I almost have stopped looking at it whatsoever because this thing is an abomination. I mean, it's not doing anything. It's not following yields. It's not following risk. So in all honesty, I have stopped finding any reason why I should care about what USD yen does until it actually starts doing something. Okay. If you notice, it has started working mostly as a proxy of the DXY, index, than anything else. So it's, in my opinion, it has lost all the worth it had for me as an FX trader. So until it starts being a real market again, because this is not a real market. Now we can have a debate about why it isn't a real market, but it doesn't really matter. For all intents and purposes, I couldn't care less. But this is not a real market. So, if any of you want to waste your time trying to trade this, I'm going to wish you the best of luck. May you do very well. But I think you're wasting a lot of energy, time, and money in trying to trade something that you shouldn't be trying to trade. That's my personal point of view in the USD yen. Let me go through some of your questions. Hi, Steve. Aussie pairs. We already had a look at the Euro Aussie. Big reversal. Let's have a look at the Pound Aussie as well, which shouldn't look that much different. There it is. Keep in mind that the Pound Aussie has kept this uptrend. Look how close we came to the channel. And not only that, we tested the previous low. Same low that was and is the 61.8% fib from that low to the high, and we found support there. So this looks like a nice area to move higher. Pound Kiwi, turn back, tested the 50% fib, also horizontal support resistance area, moving higher once again. I see no real resistance until we find once again this long-term ascending channels trend line resistance. You can see it here if I zoom out quite clearly. So I think that covers. We also had a look at the Aussie yen. So I think we covered a decent amount of the Aussie pairs. Euro USD is doing well. No, it isn't. I mean, as I said, I think I said it yesterday again, that it would be a highly likely scenario that Euro USD would have more downside. That's what I drew yesterday when we saw some risk off again. So there you go. It's starting quite a formidable day lower today. And as I said, it looks like today might be a pivot day and we might see more of the same for the days to follow. Why is USD MXN going up? Very simple. One of the best proxies since USD yen stopped playing ball. One of the best proxies for risk on, risk off is the USD MXN. You should expect USD MXN to do very well in risk off environments. We already had a look at the pound USD having to do with USD INR. I can tell you in advance, without having looked at it, I had warned in advance that once we got some risk off, USD INR would break the triangle to the upside and produce another high, and already a very nice daily reversal here. I think that this time we're probably going to be breaking this triangle, and the next upside resistance is 78.5. So that's what I'm expecting from the USD INR to continue higher with 78.5 being the next upside resistance. Hi, Steve, can you please cover EuroCAD? Yeah, absolutely. We can have a look at the EuroCAD, and here it is. EuroCAD filled the gap. We had been talking about the gap that might be the first area of support, right? Filled that gap at 151.50 and so far reversing higher. So keep that in mind. We rebounded after filling this gap. So be careful here. I mean, this diamond formations reversal is still valid. But on the other hand, keep in mind that what can be interpreted as a diamond can also be an alternative formation. And I said that since the beginning, like a pennant. You can see it here. That would obviously have bullish implications, right? So pay attention here what we're going to do during the next 1-2 days, because we fill the gap, and the fact that we're reacting from there might mean that the formation you should be paying attention to is a pennant and not a diamond reversal. Okay, that's what I think about EuroCAD. As I've told many times in the past, corrections are very tricky because at the beginning you get some price action, so you can make some assumptions, but then you get more price action and you can make further assumptions, and then you get more price action and you can see the whole picture. So predicting how corrective moves are going to go in advance is extremely hard. It's actually the hardest thing to do. Okay. Oh, okay, that's my cue. Liquidity versus gold price. Liquidity versus gold price. I have a better idea for you. Just overlay central banks balance sheet with gold, and you're going to see the amazing correlation there. Okay, and that's quite similar with overlaying it with liquidity. Okay. Aussie Kiwi, and I'm going to finish up with that because it is actually moving the last few days. Quite a nice move to the upside. Rebounded from parity. Keep in mind that currently getting rejected from a very nice confluence of resistances. So 1053 is a very key area of resistance. I want to see what's going to happen from there. If we actually manage to pass through that as well, I'm going to start changing my mind about what kind of a rebound this is. But so far, we're getting rejected from there from a risk reward perspective. Being short here against today's highs definitely makes sense. Do you have any suggestions on my entries and exits? That's a big conversation about how you can improve your entries and exits, and we can have it at another day. Interview time. Who do we have today, Dale?
Adem Tumerkin.
Okay, that's a tough name. I mean, at least for me.
Yeah, I think he's in he's up early with us, guys on the West Coast. I suspect he's from there. But I went to his website. You got to hear this guy.
Okay, I'll take your word for it, and I'll try to, because you know how busy.
Oh yeah, yeah. Okay. All right.
All right. Enjoy the interview.
Thank you, Steve. Okay, Adem, I'm going to get you set up here now. And I'm unmuting you.
Dimitris is asking if I see new highs in USD NOK. Actually, I believe that we might see a divergence there. I believe that we might see new lows in crude, new highs in other dollar pairs, perhaps retesting the lows or new lows in the S&P. But I think that USD NOK might produce a divergence, and I would be very interested to see something like that, Dimitri.
Okay, Adem, I unmuted you. Welcome to Face.
Hi, everyone. How are you doing? And it's just Adam, so don't worry.
Oh, it's Adam?
Yeah, it's Turkish.
Okay, so you Americanized it. How they say it in Turkey?
It's Adem.
Okay, see, so I'm from Skokie, Illinois, and see, I knew how to say it.
Yeah, so, and I'm Greek, and I have a lot of Turkish friends actually.
Oh, no, that's very cool.
Anyway,
yeah, I have a very good friend in New York actually, Omer.
Yeah, and Steve was in the movie Midnight Express.
Oh wow!
Remember that one?
No.
All right, well you got to watch it. So Adem, I want to welcome you to our community. Thank you for getting up early. I've also often said, I've been on the West Coast for a long time. My life is like a farmer, up before sunrise.
Yeah, for sure.
Sundown, except that I nurture seeds of greed for the harvest of commissions.
Yeah, no, I'm amazed you get up at 4.
So I don't know if you've used Zoom before, buddy, but there's a green box on the drop-down menu.
Mm-hmm.
And that way you could share your screen.
Oh, God.
I know you're mainly fundamentalist type analyst, but, just want to see what you look at. And while we're doing this, Adam, why don't you tell us about your origins or beginnings in the financial markets, and how you got involved in it.
Yeah, so pretty much so I just turned 28 recently, and I got into markets, senior year in high school. It was actually when 2008 happened. and I live in Scottsdale, Arizona. And
okay. Oh.
Yeah, and it really, rocked everything over here, like my high school and everything. I just remember everyone's parents and, just going broke and bust suddenly, and a lot of houses like went on foreclosure. And I remember my dad like sweating bullets about it. And I never really like kind of understood why, but then when I kind of started reading about it in the news, I was kind of like surprised that so many people were kind of duped into, the house prices falling, like just because of like all the, like how they just thought they were going to go higher. And I just remember talking to my dad about it, and he was like, oh yeah, the house got appraised for like 800 grand, but it was like 450 grand like a couple years before. And I'm like, yeah, but we didn't like renovate or anything. Why is it so much higher? And he kept just saying like, oh, real estate always appreciates and everything. And so I don't know. I just kind of was like, when it kind of collapsed, I thought it made sense, but I guess, everybody else was kind of, upset about it and wiped out.
Well, some people, it's called the Great Recession. So I
Mhm.
don't know how great it was for many people, but so it took, you're in high school, you're a senior, you're seeing us go into the Great Recession. So what do? You start reading books, and anything influence you?
Yes.
Go
So
ahead.
I was in an economics class, but like high school, I don't know if it was, back when you guys went, but it's like a total joke. And like our teacher would just put on like movies and like pass out candy just to like keep us all like quiet. But I was actually
Sounds like
interested.
the Fed.
Right. Yeah, more or less. And I was actually like interested in economics and I thought economics tied into investing back then. And like I realized that was totally wrong. Like economics is all theory. But at the time I was like, oh, economics, that's about money. So I went to my economics teacher, and he didn't know anything. Like he was previously he was like I don't even know, he was like an English teacher before just filling the role. So I was like, all right. So I had a friend who TA'd for the calculus teacher, and I went in. I used to just ditch my class and just go hang out with him on his computer. And I started just like, I was a busboy, and I opened up a brokerage when I was 17, and it was 2008. And I just started buying like a bunch of like Krispy Kreme donuts, like all these like little pharmaceutical stocks that were like, I just like speculative, that were trading for like less than $1. And the teacher saw me on like, the math teacher saw me on the browser, and he kind of was like, hey, come over here. And then on his screen he was trading options while he was teaching class. And and yeah, and I was like, it just like blew my mind. And he was like, um yeah, I do this. And he's like, I'm only a teacher. He's a chemist by trade, and he has like a master's or like a PhD in chemistry, but he was like, I just took this job because it's like, a government job, like stable income and good retirement. But
Free
he's like,
money from the taxpayer, and they can trade at the
yeah,
same time. Sounds
pretty
good.
much. Yeah, and he would teach his class for like 20 minutes, and then the next 30, 40, he was just trading. And he was like, I remember he was like talking about Goldman Sachs. I'd like never even heard of that, and I was like amazed. So yeah, I just got into. I
He
just
was
started coming in.
kind of a mentor for you.
Yeah, so he became a mentor. He made me sign like a paper that, like, God forbid if I lost money, he wasn't liable. And just he wanted to make it, because I was a minor at the time. And so I ended up every day going into my economics class. I would just check in, and I would be like, yeah, I'm going to the bathroom, and I would just like leave. I would just go down the hall, and the teacher didn't even like notice or care. And I just went to this guy's class, and he taught me about like options and like trading and stuff. And yeah, and it was crazy. And then
The only high school teacher in history to have you sign a risk disclosure.
right, yeah,
That really something. Yeah, it's a great story.
yeah, and he was like my best teacher that I never even like had, because I was never his student. And so then yeah, I just graduated in in the summer. And then I'd taken a year off because I didn't want to really waste that much money going to college for economics. I was also kind of worried at the time because I thought, everything he did was like crazy high math, and I was never really that good at math. So I was kind of like, I was intimidated. But then I went to the junior college, and I started just taking economics. And I remember my teacher telling me on like the first day, he's like, listen, I have kids who are straight A, smart, like scientists, going in for science, and they're taking this and they fail this class. He's like, because economics is a different type of thinking. He's like, you can't memorize things. It's like intuitive and it's analytical. And he's like, some people like think they can just memorize everything in school and get past it. He's like, this isn't that kind of class. So it kind of like interested me. I was like, oh, okay, cool. So I took it, and I just started like acing everything, and I started talking to him, and I was like, yeah, with economic stuff, and he was like telling me stuff about like, like, oh, there's gonna be like inflation and all these things, but I kind of was like disagreeing with him like on things. So I started Googling stuff myself, and I came across Peter Schiff, and I didn't really care for much of his stuff, but I liked how he was like taking on a lot of like the CNBC guys and like how he just came out right. And
Yeah.
I got really interested in like the contrarian stuff. But then I kind of realized later, you can teach value investing, you can teach trading, but you can't teach somebody to be contrarian. It's kind of like you know what I mean? Like it's
Yeah,
kind
I
of like
do
an
know what you mean.
emotional thing. Like some people, you'll tell them like, hey, when things drop, you want to buy more. But when the push comes to shove, they get scared and they pull out. So it's like kind of that speculative, going against the grain attitude. So that was the
Yeah.
first thing I
Okay.
noticed. Is that
Interesting.
a lot of people like try not faking. It's like they really try, but then like when a crisis happens, they freak out and they just go back to like what they think they should do. So that was like the first thing I kind of learned. And then, but yeah, long
Yeah,
story short,
their emotion of fear overrides their intuition.
exactly.
Yeah.
And it just reminded me of like 2008. And yeah, and then long story short, so that money that I had with my teacher, and I bought like Krispy Kreme donut. I bought all these tiny stocks for like less than $1. I put like $5,000 in it, and then 2013 came, I didn't even touch it. And those stocks were going for like 20, $30 now because of the Fed's QE. And I remember I just like logged on to my brokerage and I had like 70, 80K all of a sudden, like 4 years later from my $5,000 investment. And I knew it was just like, pure luck. Like it was nothing I did that made that money. So I kind of realized like, okay, now I have like a chunk of wealth. I need to like actually understand like fundamentals. So then I kind of just got into like reading Ben Graham and I went into like commodities and all those things. And then I started a website, and then I ended up just dropping out of college because I realized like I'm not going to waste the money. And my father like passed away. So I had to like, deal with that. And afterwards I was just kind of, I was like, I'm just going to go out on my own. And yeah. And then just
What a great story.
Yeah, it was crazy. And then I got hired as an analyst for, I was gonna go work for Sprott Global, and then I went to
Oh yeah, Sprott.
yeah, I went down there to San Diego, and then I never worked for them though, but I went there, got interviewed and everything, and thought it was really neat. But they went with someone else that was local, but I ended up actually going to Baltimore to work at Stansberry Research as an analyst because I knew a guy who was like, hey, you're a good writer. If you combine the two, that's like where the real interest is in like market people. You have really good analysts, but they can't write. They can't like explain it to people. And then you have people who are like good writers, but they don't understand anything about investing. He's like, if you can combine the two, you can have something special. So yeah, I went there, was an analyst, and I came back. I didn't really like living in Baltimore, so I just came back, and then I met the guys at Palisade Global, and they needed a macro analyst for everything. So they just hired me for 2 years, worked with them, and then they're about to take their gold fund, Palisade Gold Corp, public. And I just kind of wanted to go out on my own, and I started Speculators Anonymous, which is just my website now. And then I done that like for a year. Then I just took it premium just for to just try to like pay my rent and everything off it and see some interest if I could get, because I'd beat in the market for a few years in a row, just like luckily and thankfully. And yeah, and then that's just how I got to this point now.
Wow. I tell you that's you were driven, and at such a young age to be where you're at already. I could just tell you have a promising career ahead of you, and you've already proved it. I mean, you were hired by some people that they don't take anybody, Stansberry, etc. So why don't we talk about what you're seeing here on the register on your radar, and dollar strength, and what markets you really pay attention to, and what you're thinking in here, Adam.
Yeah, so I've definitely thought that markets were really overvalued. I'm a big believer in Nassim Taleb's work, like black swans and anti-fragility. And anti-fragility, for those who don't know, means to gain from disorder, which I thought was really interesting concept because you know, if things are fragile, they break. It doesn't matter, like imagine like a vase. It's even if you put the vase on a top shelf and the kids aren't running around it, it's still a fragile vase. So even if an earthquake happens or somebody bumps the shelf and you think it's safe, it'll still fall and shatter. So it doesn't change that the properties of the thing are fragile. So Nassim Taleb wrote this book called Anti-Fragility or Anti-Fragile, sorry. And it's not really an investing book, but I thought it had a lot of great concepts in there for like option trading, like optionality, that you just use a little bit of money, you know, and you don't like, you can like bleed yourself out losing premiums, but you'll never like blow yourself up if you're just buying options. So
Right.
I adopted that strategy, and I started kind of just placing small bets that I looked at were like asymmetric. Like, hey, what's the risk here? Like, okay, worst comes to worst, I lose $1,000 over the year, so a little bit less than $100 a month buying these options. But you know, if this market crashes, I can make like 10, 20 to 1. So that's kind of how I just adopted it into my like investment or speculative, you know, philosophy. And
Okay.
so I guess, yeah, so getting all that out of the way. So I'm also big on cycles, and I was realizing in 2018, I started looking at, you know, the Fed was tightening, and I
Okay.
was big on like the Austrian theory, like with their business cycle. And I was
Okay.
like, okay, with Fed tightening, that's sucking money out of the, you know, bank reserves. But at the same time, the Fed, I mean, the US Treasury is like ramping up huge dollar deficits. And I'm like, well, you know, it's creating a dollar shortage, because if the Fed's not adding money into the money supply and actually pulling it out, you know, people don't, you know, they don't think like, well, like, what's a dollar shortage? And like the whole concept of a dollar shortage is, so if the Fed is sucking money out of this monetary system, that means banks have less reserves, primary banks who buy these
During
bonds.
QT.
Yeah, during QT. So
Okay.
the 2 years of tightening were leading to like creating big fragility in the system. And I said one day, I was just writing about it, I didn't know when, but I said there's going to be something that breaks. And in September 2019, we saw the repo
Fed funds,
squeeze.
yeah.
Just blew out. And it really rocked markets. And I remember I had like a month before I'd written that, like, hey, because the Treasury came out and like, hey, we need to like, Trump had suspended the debt ceiling, or Congress, and they were like borrowing a record amount of money. And I'm like, well, you know, by them borrowing that money, all these banks don't have dollars. They don't have reserves from all the years of QTs, like suck their, you know, money dry. I have a chart actually on one of my articles I'll show you. And
okay, you're gonna have to share the screen again.
Oh, got it.
So go ahead, take it over and share the screen. I was just showing charts because you just had
sorry,
something up there I wanted to, you know.
It says you cannot start screen share while other participants.
Then I have to stop sharing. That's why. Let's see. Okay, how about now? Can you? I shouldn't have done what I did.
No, it's still the same thing.
Okay, so let me see. I should know how to do this. Okay. I'm gonna stop. I know what I have to do. Okay, let's see. Find you here. Okay. Okay. Try it now. I'm making you a co-host. Try it now.
Let's see. You will stop. Yeah. Okay. Okay, great. Okay, cool. Is my screen up? Can you guys see this?
Yeah.
Okay,
there
cool.
You go.
So yeah, so on this chart, I thought it was really profound when I was doing my research. Is that so the GSIB and the FBO, those are pretty much international and U.S. banks, and as you can see, their excess reserve balances by banks. Right when the Fed began tightening in 2015, and when actually the taper tantrums what really started it in 2014. Right. You see dollar reserves pretty much went from 1.4 trillion, 1.5. They got cut in half to January 2019, where they were just under 600 billion. So where did all those dollars go? Well, I don't have that one chart, but pretty much banks, primary banks, they were loaded up with treasuries. So the repo market was really important to them because they had to keep buying. They can't tell the government no when they're trying to issue debt. So, well, I mean, I guess they can, but they don't. And they were loaded up with T-bills, but they're like, hey, we need dollars though. So that's why the repo market's so important, is that they can put those treasuries that they just buy from the Fed onto the repo market and get cash back, as and just to keep doing it each night. Well, in September that broke because there was all sorts, just the perfect storm came together. The thing that people said like would never happen. The experts never see it coming, and then it happens. And corporations wanted their cash back for taxes or whatever. Everybody just needed cash at the same time, and the rate blew out. And then all of a sudden, the Fed began printing. They reversed the QE, which I pretty much put a chart here. Yeah. So all of a sudden, they're doing QT. It took them 2 years to cut it down. What, like 700 billion? And then all of a sudden, within 2 months or 1 month when I'd written this, it already shot up pretty much 300 billion. Now it's at a record high. It's at like almost I think it's at like 5 trillion now. So it's even higher than the QE era up until 2014.
Wow.
Yeah. So, and it's going to go way higher because the thing is the Fed's pushing rope at this point. So I guess, sorry, that was a lot of context to where we get to today. And so now, so
the Fed's pushing on a string right now. And, well, let's just think about this for a second, Adam. They were successful with their central planning from 2009 to, say, a month ago. With what they're doing now, isn't it possible that they could be successful in holding things together, not for 10 years like prior, but for a year or two?
Oh, yeah. Anything's possible, of course. And that is, I'm not saying the world's going to break or anything. That is still a very left tail, black swan event for the Fed to fail. That's not a likely outcome, but especially with the dollar strength, it's showing that even with all their printing, the world is still having huge demand for dollars. So there's going to be a wave of deflation happening. There's more demand for dollars than what the Fed can stop. Now I'm worried.
So is gold a short up here, Adam?
See, I like gold because even with all this dollar demand, gold's been rallying. And I think if you look at I have that one thing. Damn, I'd written about it a while ago. I don't have that chart on me.
That's okay. All right. So that's a true fact. Dollar has been in a pretty good uptrend, and gold at the same time, which a lot of people don't think that can happen because of the correlation. But so you think that what the Fed's doing, even if we had a real big squeeze on the dollar, which I don't think is going to happen right away, but could happen, I actually think that we're in a corrective phase there. But if that happens, won't people even liquidate precious metals? Maybe even central banks, China to defend the yuan. Under this pressure, do you think there could be central banks selling? Because what's interesting is the premium of metals, physical metals now, what people have to pay, like $4 over spot for silver and 150, $200 over spot for gold. Doesn't that make you feel as a contrarian? So I'm just bringing out the contrarian nature in me, that if the public is willing to pay a 20-30% premium to own the physical, wouldn't you say the contrarian view would be everyone's lining up to buy it, sell it to them?
Yeah, no, I definitely agree. I'm personally not buying any more gold here. I haven't bought gold since 2014 when it was $1,200 an ounce, and I've just held it. And I've bought some options on gold miners last year just because it was so cheap, and I thought the Fed was going to start easing sometime in 2019. But I'm not buying any more gold at this point. Gold miners, maybe not right now, because I want the coronavirus. There's too many unknown unknowns right now.
Yeah, closing up mines and
so I'd have to wait for, and not to mention with the VIX so high, option prices generally around are high. So I'm just kind of sitting and waiting. I made a pretty penny at the beginning of the year with some long dated SPY puts and long the 10-year. I was long since like 2018, just holding. But like, yeah, gold could definitely go down.
Okay.
Like,
You
it
know,
could
that's an
definitely drop.
interesting conversation, going to bonds. So we had TLT blow off to 180, and you know, during this emergency, they went from 180 to 140, and they've rallied back a little bit more than 61.8. Is it possible that the bond market, since the Fed went to the commercial paper market and the junk market, that the most contrarian trade would be, I hear the most crowded trade on the board still is long
Long
bonds.
bonds.
What's your view? Are yields troughing out here as people are piling into bonds for safety?
So yeah, that's yeah, it's always a hard question because yeah, long bond has been a big, like short bond
30
was
years.
really overcrowded in 2018, and I went
Yeah.
the opposite way when yields went hit 3%. I was like, well,
Okay. Yeah.
and also the yield curve started inverting in 2018, which I thought was interesting, which also bolstered the long bond theory. But right now, I personally wouldn't be buying bonds at this point because you know, the yields, it doesn't make sense. But at this time in the cycle, but I don't think growth's going to really come back until because China's the marginal growth engine, and until China, I mean, America can like print all at once. It's not going to stimulate because it's not like it's added money unless they print and give everybody 10 trillion. You know, a $1,200 payment to everybody isn't going to stimulate the economy. The loss of demand is far greater. Like, I think the stock market wiped out like 12 trillion, or now it's down to like 9 trillion off its highs. So until they can re-stimulate greater than what's been lost, which they, you know, they haven't done yet. I mean, they might. I think the Fed is getting ready to start monetizing the Treasury, but
Yeah, they've nationalized it.
yeah, and I think it's going to have to go much further because a $1,200 payment to people. I mean, I was reading like 1/3 of renters didn't even make their payment in March. So I mean, if this goes on for 2-3 more months, you know, the Fed's going to have to do $1,200 a month. You know, and that's a big toll. I mean, it cost them like what 1.2 trillion to do that stimulus with everything. So over the year, you're looking at an even greater dollar shortage then because they have to get those dollars from somewhere else unless the Fed steps in and just says, "Hey, we're going to print in buyer bonds directly." And yeah, so the reason I said that the Fed's pushing growth here and why I'm only bullish the dollar is because there's just so much debt in the system that people need dollars to pay the you know, soon we're going to get dollar disease, which is that term by Irving Fisher from the Great Depression, when people have to start liquidating assets, which could be, you know, could be gold, just to pay the interest on their dollar debt, or these other corporations. And
I have another book recommendation because I was influenced by something like this early in my career, called The Great Money Panic by Dr. Martin Weiss. I think it was written in the 70s or 80s when, you know, rates were spiking to 18.
never
And
heard of that.
and he describes, and I'm wondering if you could see this too, where rates aren't going up because of growth, as you were talking about. They're going up because of the demand to roll over debt and not as much demand for the paper.
Yeah,
So
that's
your
what was
rates
that
could
called?
go up because of supply. The Great Money Panic by
Great
Dr. Martin Weiss.
Money Panic. Yeah, I'll have to check
Yeah,
that out.
so
That
you know, he
sounds
talks
interesting.
about in a liquidity crisis, rates going up to 20% and the dollar being good and everything else being bad, that kind of scenario sucks money off Mars.
Yeah, I mean, that's definitely a possibility. Like right now, everybody, we're all like in uncharted territory. Like you would think, because in 2008, right when the Fed started printing, the dollar dropped and like foreign currencies rallied. There was
Yeah.
like a big, you know, we only see those big money regimes like currency wars, like Jim Rickards talked about a couple times, like every
Yeah.
generation. And it was like 1930s, 1970 or 45 with Bretton Woods, 71 with the gold breaking, 2011 or 2009 to 2011. And now we're at another point where are they going to have to do like a Plaza Accord where they have to like get together with foreign countries and cheapen their dollar? But if everybody's, you know, grasping for growth, you know, who wants to have a strong currency now? I mean, you see Trump all the time going out there saying like, "Hey, we want to cheapen our dollar," but it's not really
Right.
up to him. I mean, I guess he
Who's
could.
it up to?
Well, that's the thing. I guess he would have to get everybody on board, because even if he cheapens the dollar, what could stop the other central banks from cheapening theirs? And it's just a race to the bottom. And that's what Bernanke came out with in 2009. The theory, what if everybody cheapens at once? Which I don't think he understood, like, the relative market of traders, because you can't have everybody trade. It's subjective value. So everybody has, if one cheapens, if everybody cheapen at once, nobody would be better off, because it's like a beggar thy neighbor kind of prospect. Like, if you cheapen artificially against country A, country B gets a spurt of growth. And I think that's why. So post 2008, China's been the marginal growth engine. So if you look at the last 3 down cycles, like 2012, 2014, 15, and recently, it's up to China's demand, because I was reading an IMF report, and China post 2008 accounted for 49% of global GDP. So, like, wherever China goes, the world goes. And in those last 3 cyclical slowdowns, China did big stimulus. They took a lot of debt, and they eased a lot, and they started rallying. Like, the markets went with them, because they started growing, and they were like the train moving everybody.
Right.
But China hasn't really been doing any stimulus. And I think it's because in 2016, I'm sure you guys know that, when President Xi went out there and pretty much said, hey, he wants to rein in the shadow banking industry and, like, kind of curtail the lending. So they haven't been as aggressive with their stimulus. And an indicator I like to use for, China as a leading indicator for their demand is the China M1 growth rate year over year. And if you look back at it historically, before each cyclical upturn, before each cyclical downturn, the M1 year-over-year growth rate crashed, and then their demand slowed, and then the global economy, like, reeled. And then when it started picking back up into the double digits, that showed that Chinese demand was coming back. There was a high turnover of cash. And but right now, at this point in the cycle, it's still very anemic. It just hit 0% year-over-year last year. I'm sorry, January this year.
Wow.
And recently it just hit 4.8%. Now it just hit 5% in March, but that's still cyclically, like, really low. So it shows that
half of what it used to need to
exactly
generate growth.
Exactly. And that was always a leading indicator. And one thing that I learned a lot from systems thinking is that there's big lag effects and, like, feedback loops.
Yeah.
Like aggressive and then stabilizing. Aggressive, real, something like Soros came out with. Reflexivity is pretty much just feedback loops. And
so that's what we got in S&Ps with the aggressive Fed action was, where you got this bounce, but what you were talking about, it may not last long term.
Yeah,
right?
I personally don't think it's going to last long term. I think we still have more further down to go. And I do think that the dollar is going to drop a little bit in the short run, because I think, a lot of people are jumping back in to the market thinking it's the bottom, and it could be. But I personally, there's a really good book by, I forgot his name, but it's called The Anatomy of a Bear Market, or The Anatomy of a Bear. By Russell Napier, a very, like, profound economist. And he went back and studied in 2011 all the great bear markets, the big 4. And what he found was they were all led up to was with deflation. So what we're seeing right now in the world is a big wave of deflation, with all this loss of demand. That's why I said the Fed's just pushing rope. It's just there's too much deflation. There's too much loss of demand. The supply chains are like China's recent export numbers were negative, like 7%.
Yeah.
And the U.S. numbers were not that great either. And I'm assuming it'll get worse, because there's, like, a lag effect. It's going to get worse before it gets better here.
So cash is king, huh, Adam?
Yeah, I think cash is good here, but I wouldn't buy bonds. I do like gold, but it could have a big sell-off. How I usually play things, I just like to do options. Like last year, I'd bet against the Australian dollar. I just bought 1-year puts on the FXA, the Australian Dollar Trust, and or the British pound and everything. But right now, it's just everything's too, like, roughly priced. On the foreign currency market.
So let me ask you this: you've been in it for a while. Are you still uncomfortable doing nothing?
Well,
I
actually,
feel sense it in your voice a little bit, like, there's nothing really out there compelling.
I've been really big on uranium for the last 6 months.
Oh, okay.
And uranium's actually just broke out to its 4-year high right now because the global, I don't know if you follow uranium. Like, I'm not a huge uranium trader. Like, I know a lot of them get crazy.
I'm a little bit more into kryptonite.
Oh yeah, like, yeah, like, it's
No, but I know what you're saying. Yeah.
yeah, it's known as like the widowmaker trade, I think, because so many people get killed going every year. It's supposed to be uranium's breakout, but I actually am long uranium at this point just because the capital cycle like there's been aggressive supply cuts. So
Okay.
finally you're seeing like huge deficits in uranium, and like the world's biggest uranium mine, which was the Cigar Lake mine by Cameco in Canada, they just shut it off.
Wow.
And
Okay.
Kazakhstan is the largest exporter of uranium in the world, and they cut their output for the last 3 years in a row by 20%. So finally, that put a floor on the uranium price, and finally it's breaking out to a 4-year high. So I've been long Cameco options, but I've just held them for the last few months, and I still have many months to go on them. So I'm hoping, it just keeps rallying. But so I've been long uranium, but other than that, like, I really don't have many good ideas at this point, except,
that's,
I think
that's fine. On Twitter, what do people choke on Adam on Twitter, saying I was wrong and I don't know, and to say I don't know is wisdom. Naturally it feels like, oh, I'm dumb, I don't know, but to realize it and there's nothing there is wisdom. What a great interview, Adam. I'm so glad I reached out to you on Twitter, and
yeah, I really
God,
appreciate it.
you and I could talk for hours about what's going on. So let's do this again down the road and see how things are shaping up. And you know what? Whether you like it or not, you're now Forex Stop Hunters trading warrior brother.
Oh, I appreciate it. I really appreciate you reaching out and everything. And thanks for having me. And
yeah,
guys, I really appreciate it, and I like what you guys do.
Yeah, and if you why don't I do this? Let me why don't you show your website before you go?
Oh yeah.
It's a nice looking site. So this is where you could find Adam, and his Twitter handle is at Radical Adam.
Yeah, Adam with an E, ADEM.
Yeah.
A lot of people get that wrong. Yeah.
Adam, and your other homework assignment is to watch Midnight Express to see what freaked me out in my 20s when I saw that movie.
Awesome.
So anyway, are you showing your website?
Yeah. Oh, sorry.
Yeah, just share it and show it. And
sorry.
That's okay. So you're still in Arizona?
Yeah, I'm still in Scottsdale.
Okay.
Yeah, it's starting to, the car market's starting to really turn over here. So
okay, you know what? I want to ask you about this, since your initial impression on everything came from a real estate collapse. There's been talk during this recovery here. I'm in California, in San Diego, and prices have taken out the 08 highs. Like a few years ago, we've already surpassed them. And they talk about housing shortage for the last few months because they haven't built as many starter homes. But, during 08, hedge funds bought up all these single family homes. Do you think deflation can take its toll on real estate again to the same degree as it did in 08, 09?
Yeah, I mean, I definitely think it could. I don't think it's going to be as bad because going back to like the capital cycle, there was such a massive inflow of home buildings in 2008 that did get bought up by hedge funds. So unless they start selling, but I think if the Fed is pretty much guaranteeing, like a hedge fund could just go to the Fed, or they could just not directly go to them, but they can keep rolling over their debt or getting cash because now the Fed's pretty much insuring everything. I think the Fed's really worried about that big wall of near junk debt, all that triple B debt that's like one notch away from being downgraded. There's like a record amount, like $4 trillion worth of triple B debt. I think that's what they're really worried about, because once you have those go over, it'll suck the air out of the junk bond market, because a lot of hedge funds, pension funds, they can't own. Yeah, sorry, hedge funds can. Pension funds and
why are we bailing out hedge funds?
I just think the idea of them, it's that weird central bank idea of the wealth effect, is that if you have one go under, that it'll just take away global demand. It'll cause a bank run. People will be like, well, what if that's my hedge fund, and they go and take their money out. So I think ever since 2008, the Fed's just trying to keep everything from teetering over. But then who bails the Fed out?
How do they fail? Do they not fail?
I think that's just the people will one day just be like, hey, enough is it. But everyone thought negative rates would maybe be that, like, oh, negative rates never. But sure enough, rates look like they're going to go negative maybe pretty soon.
Yeah,
they're already everywhere else. So I think until people or traders or investors finally stop buying into it. But I think it's like the dollar and the Fed, it's the prettiest mare in the slaughterhouse. Everywhere else looks so much worse that they're just going, where's the least bad at this point?
Okay. Great interview, Adam. You have a bright career ahead of you. I'm glad we met, and thanks so much for your time today.
Oh, definitely.
I learned from you today, so thank you
Well,
thanks for edifying
learn more from
us.
you and everything.
Okay, well, yeah. Okay, learn this. Enjoy being young.
Yeah, no, definitely.
All right, because we all think money's the most important thing. You know what is? Time's your most important currency.
Yeah, you're right, definitely.
Well, how do you know that yet?
Just when my dad died, I was like,
oh, that'll do it.
Yeah, that was definitely a big wake up. So, also steeled my nerves a bit, but no, definitely. But no, thank you for that. And thank you for having me, everyone. I really appreciate it.
It was great, Adam. I'm really glad we met. So good luck to you, and let's set up a date for, sometime in the summer, June or something, for you to come back and fill us in, okay?
Yeah, absolutely.
All right, so that's going to be a wrap. Everyone has appreciated you, and I'm going to, I guess, say goodbye to everyone. And remember, this is what I say, Adam. Don't just count your pips, count your blessings. See everyone tomorrow. Good hunting the rest of the session.
Absolutely.
Adios.
Thanks, everyone. Bye.
Adios.